This has been one of the wildest years in the stock market, up big one month, down the next. And even though the S&P is up 17% this year, a lot of investors probably lost money because they timed their buying and selling incorrectly. So today, we're going to look at what Warren Buffett is doing and, more importantly, what he's advising people like you and I to do when the market feels unpredictable. In this video, we're going to help you understand how to approach investing when the market feels uncertain, whether stocks are selling at all-time highs or the market is falling. We're going to do this while using Warren Buffett's guidance and examples. We're going to walk you through the principles that have helped him succeed for decades, the best track record on the longest period of time, and more importantly, how you can apply them to your investing journey in 2026 and beyond. So whether you're just starting or you're trying to make better decisions with your investments after years of investing, this is the kind of clarity and direction every investor needs right now, and they need to remember it for years and years to come. So before we dive deeper, let me ask you this question. When the market gets loud and confusing, who do you trust? For me, it's simple. I go back to the principles of Warren Buffett and Charlie Munger. They're not hype chasers. Buffett has been well known to never chase hype. He's a business owner, and his advice works when everyone else is loud and scared. And right now, the news has been very loud. Stocks are near all-time highs. Volatility has picked up quite a bit. AI stocks appear to be in a bubble, and maybe you're wondering if you should sit this one out or jump all the way in. That's exactly why Buffett's voice matters more now than ever. Because in times like this, when things feel uncertain and overpriced, you need to lean on the timeless wisdom, not the trending headlines. Buffett's not guessing what's going to happen next. He's focused on what's always worked in the long run. Now, when that market gets wild, most people feel one of two things, fear or greed. That's why we have the fear and greed index. But Buffett, he stays calm. And he said it best. The recent market swings amount to nothing. That's coming from a guy who's seen every kind of market you can imagine. Huge booms, huge crashes. So when he tells us not to overreact, you must listen. Buffett warns that investing based on emotions is one of the biggest mistakes people make. I would argue that it's not investing. You panic, which means you probably sell too early, and you get greedy, which means you buy the wrong stocks at the wrong time. Remember, no matter what happens, if you pay less than something's worth, you're probably going to do well. If you pay more than something's worth, you're probably going to struggle in your returns. So in times like these, when headlines are screaming, you got to ignore the noise. Focus on buying strong businesses that you would hold through thick and thin, because that's what real investors do. Now, let's look at what Buffett has actually done recently, not just what he says. When prices are high, Buffett doesn't feel pressure to do anything fancy. And that's exactly what we've seen in 2025. He's actually pulled way back in buying. In fact, he even stopped repurchasing shares of his own company, Berkshire Hathaway. Instead, Buffett's sitting on a mountain of cash. Why? Because he's waiting. When stocks are expensive, sometimes the smartest move is no move at all. Yes, Berkshire did buy 17 million shares of Google, but don't miss the big picture. Buffett and Berkshire are still a net seller of stocks this year. He's been trimming back some of his biggest positions like Apple and Bank of America. Bank of America, he has held for a very long time. That tells us something really important. Even the best investors know when to hit pause. So what can we learn from this? Well, when everything feels overvalued, you don't have to chase. Patience is a strategy too, especially when you're following price versus value. But guys, most people feel like sitting on your hands is doing nothing, and therefore that's bad. That is not the case at all. And I will acknowledge, Buffett's approach to investing is not something you should mimic in terms of how you buy and sell. His goal is to preserve that wealth. Your goal is to grow your wealth. So I understand there are differences there, but you still need to look at his actions to realize where we are in the markets and what you should be learning from that. So the question becomes, if Buffett isn't buying right now, what should I do? Well, imagine if you could sit down across the table from Buffett and ask him, what should I be doing in 2026? I'm going to walk you through 5 clear, simple strategies that I believe Buffett would tell you to follow in this kind of market, especially if you're just starting out. Now, guys, all these rules can be used to save you from big mistakes, individually as a group. And one of the most important ones is this first one. Only buy what you understand. Sounds simple, right? But most people don't actually do it. They buy stocks because their friend told them about it, or they saw someone hyping it up online. They saw the big gains. That's not investing. That's gambling. That's hoping. Buffett says if you can't explain how a company makes money, then you shouldn't own it. He's not sitting there saying that if you can't understand how a chip is made for NVIDIA, you shouldn't own it. That's not what he's saying. What he's saying is, can you understand how they can grow their revenue and profit, and along with that, determine reasonably how much money they'll make in the foreseeable future? This is why he set out the tech boom back in the late 90s. He sat there and said, this industry is brand new. I have no idea who the winners and losers are going to be in the next 10 or 20 years, and I have no idea how much money the winners will be making. And here at Everything Money, this is actually the third tenet of our principle-driven investing that we live by. If we don't understand it, we don't invest in it. Because here's the truth. If you don't understand how a company makes money, then when the stock price drops, you won't know whether it's just a temporary dip or a sign of real trouble. Is it the market just voting it down, or is there something fundamentally wrong with the business? And what do most people do when that happens? They panic and sell. And sometimes they sell a good business and don't even know it. And guys, I'm gonna let you in on a little secret. It's actually easier for me to buy companies when the entire market is falling, because at that point, everything is falling. It's difficult to buy a company that's not doing well in a bull market, because then you have to sit there and wonder, is this truly a problem with the company, or is it just the market overreacting? But most people have a hard time when the entire market is falling. That's why I want you to continue watching this channel, especially during bear markets. Buffett's advice is, don't panic sell a good business. It's the exact opposite of what people do. That's like going to a store, seeing everything on sale and running out saying, I got to avoid this place. If the business is still strong and the story hasn't changed, why would you sell it for less? Especially when you have the opportunity to buy more of it because somebody else has overreacted. Guys, there are a lot of businesses right now that I pass on. If you remember the EV surge a few years ago, all these companies stocks were flying high. I did not lose sleep once thinking I was losing out on some sort of gain, because I was like, these companies make nothing, they do nothing. In fact, there's a YouTuber out there named Stock Mo, and he talked about a company called Workhorse. And he sat there and said, no matter what happens with Workhorse, I'm going to be an investor forever, even if they don't get the United States Postal Service contract. And I remember thinking to myself, if they don't get the United States Postal Service contract, what company is it? It's a nothing company. So did I buy it hoping to get the Workhorse United States Postal Service contract? Absolutely not. And guess what? When they didn't get it, what did Stock Mo do? He hit that sell button immediately. That's not investing. That's speculation. That's gambling. So if you understand what you own, if you really understand it, you're going to stop guessing. You're going to start thinking like a business owner, and you're going to be able to ride through the ups and downs like a true investor, which is a real value investor. So now that we've talked about buying only what you understand, another important lesson that Buffett teaches is just because a stock's price is low doesn't mean it's a good deal. What I always say is, just because something is cheaper does not make it cheap. So guys, before I get into this principle, back in high school, this is 1997, 1998, the stock market's booming. A kid in our class, I was in Algebra 2 Trig, and my teacher was a track coach, and a kid in my class raised his hand and said, hey, do you have Nike stock? He said, I wish. I can't afford it. And I was like, what do you mean you can't afford it? It's $40 a share. His comment was, $40 a share is too much. I can't buy a lot of shares. And I was like, but that's not what the value of the business is. Now, I was fortunate to understand that back then, but it's something that people don't understand today. Berkshire Hathaway stock, Class A shares, are selling for hundreds and hundreds of thousands of dollars. Yet the entire Berkshire Hathaway company isn't worth anywhere close to NVIDIA's company market cap at $170. That's the difference. Price versus value. What's the company worth versus what price are you paying for a share? Don't worry about the price per share. Worry about valuing the entire business. If you value the entire business well, and if you can buy the per share value right now on the market at a price lower than that, you're going to do well. So guys, the analogy I always give is, let's say you own a home that's worth $400,000. If tomorrow you sat there and said, I'm going to put it for $4 million in the market and it doesn't sell, but then you lower it to $2 million, is it suddenly cheap? No, it's cheaper, but it's not cheap. That's price versus value. That's what you've got to remember. Back in the day, Buffett used to invest in what he called cigar butts. These were companies that were basically dying businesses, but had one last puff left that people were mispricing. He would buy them dirt cheap, squeeze out the last bit of value, then move on. But things changed. His partner, Charlie Munger, came into the scene and convinced him, don't dig through garbage looking for scraps. Instead, buy great businesses at fair prices. And since then, that's what Buffett's been doing. And his wealth has exploded. He ranks companies by quality, not just how cheap their stocks are. And that's the lesson we follow here at Everything Money too. Because a higher quality business deserves a higher price. I think we'd all agree that if two companies are generating $1 billion each, but one can grow at 20% a year and the other one's declining, they're both generating $1 billion today. Which one is worth more money? Clearly, the one growing 20% per year is worth more than the one declining 5% a year. With that said, if the two companies are making $1 billion and one is growing 20% a year and one is declining 3% a year, would you pay $100 trillion for this one? Of course not. Would you pay $1 for this one? Of course you would. The point I'm trying to make is price is what makes the difference. The price you pay is what matters. We're not chasing the lowest price tag on a stock. We're hunting for the best companies where price makes sense for value. We want price a lot lower than value. That's why I use my stock analyzer tool immediately. It helps me figure out what I think the business's fair value is. Is it overvalued? Is it undervalued? Meaning, am I paying less than it's worth when it's undervalued? And guys, not all companies, even the popular ones, especially the popular ones, are probably worth the price. That's why value matters more than popularity. Don't buy a stock just because its ticker symbol and ticker price is climbing. That's speculation. That's not investing. A rising price doesn't mean value. I give the example of Palantir. It was at $45, fell to $5.83. According to the logic of the people out there who are hypesters about it now, you should have avoided that stock forever. It went from $5.83 to almost $200 a share, maybe it surpassed $200 a share. Is it worth $170 that's at right now? Probably not. But at the end of the day, the point is, if you chase the stock price, you're going to miss out on opportunities. And this is exactly why our fifth and most important tenet of principle-driven investing is this. A great story becomes a bad investment if you pay the wrong price. Flashy headlines and trending stocks are no substitute for quality businesses that you purchase at reasonable and smart prices. That's how real investors build wealth. This leads us to our third piece of advice from Buffett. Once you've found a great company at a fair price, what do you do next? You hold it for as long as you can, hopefully even decades. This is one of the simplest and most powerful investing principles. Buffett and Munger always said, find a great investment and sit on your hands and let compounding do the rest of the work. But it's so difficult to do that, especially in a market like this one where prices are flying up and dropping week to week, day to day, month to month. Buffett has made it clear, and this is one of my favorite things that he says, only buy a stock if you're comfortable owning it, even if the market closed for 10 years. In fact, everybody's returns would skyrocket if that was the case. I absolutely guarantee that. That's how much confidence you should have in the business. And it'll eliminate as many fluctuations in price you have to worry about. I look at an example like Dell Corporation. If you go look at Dell's history, Dell was the darling stock of the 90s. There were fan groups. It was almost like a little Tesla thing. And then it started to slack. So in the late 2000s, Michael Dell and a bunch of investors went private. They thought the stock was undervalued. They said, listen, let's go private here. Let's take the company private, focus on growth. Guys, Michael Dell is now worth $150 billion. When he went public again, the entire markets forgot about all the bad rep of the 2000 to 2010, and they valued the business again what it's worth. Guys, I challenge anybody here to show me a situation in which a company was selling for a reasonable price, and 20, 30 years down the road, the profit was up 10, 15, 20 times, and the stock wasn't up, something similar to that. But remember the caveat there that I said. It was selling for a reasonable price to start. Cisco, their profit is up 10x from 30 years ago. But from 25 years ago, the stock is down. Why? Because it wasn't selling for a reasonable price in 2000. In the short run, guys, the market can feel like total chaos, because guess what? It absolutely is total chaos. It's random. Prices bounce all over the place for reasons that often don't even make sense. Fear takes over, or greed, and that's when people make bad decisions. Buying too high because of euphoria, or panic selling when things dip because of fear. But a great business, one with strong profits, solid management, and a real product that people want, that kind of business can and will handle the storms. And when you stay patient, when you let time and compounding do the heavy lifting, that's when real wealth gets built. At Everything Money, that is part of our principle-driven investing approach. We don't chase short-term pops and hype. We focus on long-term plans. And when I say long-term, I don't mean the SEC and IRS 1 year long-term. I mean decades. Every stock I buy, I think to myself, do I want to own this for 20 or 30 years? Now, once you've found a good business and you've bought it at the right price with a plan on holding it long-term, you'd think the hard part's done, right? Maybe not. The truth is, the hardest part of investing isn't finding the company. It's staying disciplined. That brings us to something Buffett believes separates successful investors from the rest. Temperament. Not IQ, not credentials, not Harvard educations. It's temperament. So let's talk about that. Sometimes the hardest battle in investing isn't with the market. It's with yourself and your own emotions. Fear, greed, FOMO, human nature. When you let those drive your decisions instead of logic and analysis, you're almost always going to underperform. I mentioned this at the start of the video, but let me share this as studies confirm this. Research shows that individual investors, especially those who trade frequently in and out of stocks, tend to underperform the market. They buy when everyone else is buying, and they sell when panic hits. One very well-known report from Berkeley's Haas School of Business showed that average equity fund investors often earn far less than just holding a broad index. Why? Because they buy high and sell low because of emotion. They chase hot stocks up and they flee during dips. That's why temperament matters so much. As Warren Buffett says, treating stocks like ownership in a real business, not as lottery tickets, is the only sustainable way. Don't panic sell. As I've said many times in this video, don't buy a stock just because everyone's talking about it or because it's going up fast. When you see volatility, when you see hype, that's not a signal to follow the crowd. It's a signal to check your mindset and emotions. If you keep your emotions in check, if you stay disciplined and remember that you own part of a business that is going to be around for a long time, not just a ticker symbol going up and down, you're going to avoid the mistakes that most investors make. Now, if there's one thing that Buffett has warned about time and time again, it's not just the mistakes we make, it's the opportunities we miss. And in volatile markets like this, it's easy to get paralyzed or overwhelmed. But that's exactly when smart investors lean in. Buffett calls this an error of omission, doing nothing when things feel uncertain, sitting on their hands during a market dip, waiting for some perfect time to invest. But here's the truth. That perfect time never shows up. Trying to time the market is a losing game. You're going to miss the rebound or buy in too late. You might get a temporary good feeling because you didn't buy, the stock went lower, but then you know what you're going to do? You're probably not going to buy again thinking it's going to go even lower. Warren Buffett has said many times that volatility, those wild ups and downs, isn't a disaster. It's an opportunity for real investors. When prices tumble, and they tumble quick, if you stay disciplined and look for value, you often get a chance to buy great businesses or solid funds at a discount. That's how value gets built over time. But here's the catch. You still have to know and understand what you're buying and what price you're paying relative to value. So when the market shakes, don't freeze up. Use it as an opportunity to buy quality at bargain prices, but only if it meets your price. Don't chase hype. Don't guess. And guys, I want to repeat till I'm blue in the face. The long-term average for S&P 500 is 15 or 16 times earnings. That doesn't mean every company should be valued at 15 or 16 times earnings. Some deserve a massive premium. Great businesses out there deserve a premium. How much? I don't know. That's the art of investing. Warren Buffett bought Coca-Cola in 1987 at 30 times earnings, and he's made 12% returns since then. Pretty solid for paying 30 times earnings for something. But that's what we teach on this channel, how we put all those numbers together. And as I've said before, one of the biggest mistakes is not following through and sitting on the sidelines and watching opportunity walk by. Now, guys, Warren Buffett does talk very clearly about the things you should be doing. And it sounds like it's old and repetitive and like, oh my God, that's so boring. But guys, guess what? In investing, boring works. Boring is what gets you rich. So what does he tell his own family members? Dollar cost average. Why? Because it works. And here's what I tell people. I've said this in other videos. Dalton, our analyst in-house, messaged me and said, Paul, how do I tell somebody when markets are overvalued that they should DCA? People in the questions and comments say, Paul, wait a second. If markets are overvalued, why should I be doing this? And when I say this, go look at our comments. People say it all the time. And guess what? I don't blame them. It's a very logical question, one in which we ask in-house. But I tell people, dollar cost averaging isn't about worrying about, it's about getting the habits in place. Because if you start to hold back on dollar cost averaging because markets are overvalued, you're going to look for any other reason, no matter what it is, to not dollar cost average. That's the point of it. Do I think markets are overvalued? By 130%. What did I just do? I just bought part of the S&P today. Now, did I buy any individual stocks today? No. Why? Because I think there's a lot that's overpriced out there. Are there some value plays out there? Yes. And I sold cash secured puts. But Buffett talks about dollar cost averaging because you need to take your thinking and your emotions out of it. Just do it month in, month out, get the habits going. But if you're buying individual stocks, you need to pay attention to these 5 rules. That's what's key there. Now, you heard me mention a few of the principle-driven investing tenets in this video. But if you want all 5, I've put them together in one simple PDF. It's a great cheat sheet that I read every single day. So if you want that cheat sheet at your disposal whenever you want, click the link in the description to download it completely free. Guys, if you really immerse yourself in it, I assure you it'll change the way in which you invest, and it'll help you feel calmer in your decisions, especially when the markets are falling. Now listen, no one knows what's going to happen in 2026. Everyone can make their guesses. It's all BS. And the stock market in 2026 might feel loud at times and unpredictable, but the best investors stick to the principles. Warren Buffett's wisdom has worked for decades, and it's even more valuable when things feel uncertain. The markets go up and down. Guys, it's easy to look in the past and say, oh, look, the market was going up. But during those years, there were ups and downs, and it was hard at times. So if you've made it this far in the video, you're ahead of so many more investors. We do this on this channel, and we don't know anybody else on YouTube of size who does the same thing. So I want you to keep learning. I want you to stay disciplined, and I want you to trust the process. And if you want to see how I personally apply these lessons to pick stocks, click the video on your screen now, and I'm going to walk you through it step by step. Thank you for your time.